Not yet, because we haven't really seen it hit the consumer yet. I think Steve hit the nail right on the head. It turns out that when the going gets tough, the tough actually go shopping. And you heard that in the last segment, or half an hour ago when you talked to some of the retail CEOs that sort of spoke to that quietly so as not to jinx it. But everything that we see says the consumer is in good shape. Where it might get tough, when companies begin to pass through the impacts of tariffs into end consumer prices. We haven't seen that wholesale yet. That could begin to have an impact on consumer sentiment, but that's not a projection. That's a risk to keep an eye on.
But I wonder if that channel is already happening. I mean, you saw the consumer sentiment number last week that weakened. We know people talk about it in headlines, whether they're being polled about politics or the economy. Could that be a channel of, and in fact, even this Zillow survey, just anecdotally talking about bidding wars and interest in real estate, they said some people are worried about the recession headlines they're seeing.
And the beauty of this whole economic cycle has actually been how modest it has been. It's a rather broad silver lining in the otherwise dark cloud of the slowest economic expansion on record. It's also the longest on record. Those are two sides of the same coin. What this economy has lacked in vitality for the past decade, it's made up for in durability. That's not a bad trade-off for investors.
Right. At the same time, Paul, what we've seen in the markets is a defensive positioning. We see, utilities, REITs, and staples do well. How are they looking at this point?
Well, I think, just getting back to what Steve was talking about earlier, I think the word of the day here is mixed, not only in the Beige Book and among Fed officials, but the economic signals that we're seeing are extremely mixed. The back and forth contradictory tweets, headlines, and reports over trade with China are mixed. And, what does it leave us with? A market that since the beginning of August has been moving up and down above 29.25 over and over. And again, we've lost count of it. But the market is stuck in a range here. And as far as what's going to break us out of the range to the upside or the downside, I think we'll start to get some clues towards the middle of the month here, not only with the Fed meeting, but also when we start to get reports. The ISM manufacturing was one of the first August reports, but when in our consumer pulse surveys this month when we talked to people in August, the headlines really did cause a little bit of a damage to the psyche of consumers. So we'll see how that pulls through. But it's just a waiting game to see how we do pull out of this range. And I think at this point, I would say, in the longer run, I would say to the high side here. But, day to day, it depends on the headlines with the market here.
Scott, are you defensively positioned?
I would not from an asset allocation perspective. Okay. We remain fully exposed to equities because the fundamental story is still pretty good. I mean, you've got decent economic activity. I mean, leaving aside the trade war, which you can't do, I know that. But if you leave that aside for a moment and look just at the underlying fundamentals, it's a pretty good picture for equities. Within the equity market, maybe slightly more conservative with an exposure to those companies that are exposed to that robust strength in consumer spending that we see being robust.
It's just interesting to me, and Paul, correct me if I'm wrong, that real estate has surpassed tech as the best performer of the year. Is that right? I mean, what does that tell you?
Well, so, investors are hunting for yield, and they're going to sectors that are providing it. And to Scott's point, you can't dismiss the trade war here. But in the beginning of the year, the two biggest worries we were looking at were the trade uncertainty over trade and the yield curve, which was flattening. Now, that's all you hear about is a trade war and uncertainty. And usually when those worries are front and center of everyone's mind, they tend to be priced in, hence the market going nowhere over the last year. So those cons are well known here, but looking at other factors, sentiment has become really depressed. We've been seeing below average sentiment, and lower interest rates are not only stimulative to the consumer, which is good for the consumer-facing sectors, but it's also lowered borrowing costs, made homes more affordable. And in years when we've seen fixed income and treasuries do this well at this point in the year, for the remainder of the year, equities have tended to perform as well, if not better, than bonds going forward.